The Property Bulletin by London Property, the home of superprime.
Middle-income homeowners in London and the South East face mounting anxiety over Rachel Reeves's upcoming mansion tax. From 2028, properties valued over £2 million will pay between £2,500 and £7,500 a year. While aimed at wealthier owners, many caught in the net are asset-rich but cash-poor, often elderly, long-term residents in modest homes that have simply risen in value. Critics warn that valuations will be messy, appeals widespread, and the levy may push people to sell or downsize under pressure. Market behaviour is already shifting, with buyers aiming below the £2 million mark and high-value homes losing traction. The Treasury expects only around £430 million a year, small in the context of national spending, yet the impact on affected owners could be heavy. The bigger concern? That this is just the start. Many fear thresholds could creep down and pull more ordinary families into the bracket over time. For those living in pricey postcodes, the worry is simple. A tax intended for mansions may end up hitting far humbler homes. London's property market is enjoying renewed momentum, fueled by developer London Square and a surge of UAE investment. Since being acquired by Al Dar, the £13 billion Abu Dhabi-backed group, London Square has rapidly broadened its portfolio, from £325,000 homes in Croydon to £18 million penthouses in Westminster, as well as character projects like Victorian school conversions and the Surrey County Hall redevelopment. Experts at a recent forum highlighted rising interest from Middle Eastern buyers, who see London as a long-term wealth store rather than a short-term play. Strong legal protections, top-tier education, and consistent historical capital growth keep the city attractive to global investors, including Nigerians able to secure mortgages of up to 85%. While off-plan purchases in the UK may grow more gradually, analysts say the long-term returns and rental yields remain compelling, especially around regeneration hotspots in Zones 2 and 3. With UAE capital flowing in and confidence building, many believe now is a strong moment to secure a foothold in London real estate. Greenwich has been named one of London's best places to live in 2026, celebrated for its parkland, riverside charm and close-knit community. Locals say it's the friendliness, creativity and calm that make people stay for decades, from elderly people who moved there in the 60s to families who've raised children on the same streets. Residents praise the mix of green space, culture and village-like atmosphere, dog walks at Greenwich Park, GCSE astronomy at the observatory, and a thriving makers community showcased at Made in Greenwich. Despite growth and rising affluence, long-timers say the character hasn't changed. With homes averaging around £564,000, strong transport links to Canary Wharf, and a scenic setting by the Thames, it's no surprise locals say once you move to Greenwich, you never want to leave. Big freeholders are split over whether to keep fighting government leasehold reforms after losing their High Court challenge. One major player, ARC Time Freehold Income Fund, has applied to the Court of Appeal, hoping to overturn the ruling next year, but others, including Grosvenor and John Lyon's charity, have stepped back, accepting the judgment rather than extending the legal battle. The case centred on the Leasehold and Freehold Reform Act 2024, which scraps marriage value and allows 919-year lease extensions. Judges dismissed claims that the reforms breach freeholders' rights, a decision hailed by ministers as a win for millions of leaseholders. More legislation is expected soon as the government pushes towards phasing out leasehold entirely. Campaigners say the tide has turned, while freeholders fear the verdict sets a precedent for wider state intervention in property markets.
Subscribe to our newsletter to receive our weekly bulletins and stay ahead of what's shaping the superprime property market.